Good morning, everyone. Thank you very much for attending the webinar today. So I'm just going to give it a minute, let everybody who is supposed to be attending attend. And I'll be with you guys maybe in about a minute. All right, thank you. All right, thank you everybody for attending. We'll just get started, and whoever attends, but so far we're still missing quite a few people. But, okay, they're all coming. Anyway, my name is Justin Ishac, Senior Investment Manager here at HNWIs. Thank you very much for attending again. Today we'll be discussing the ultimate dividend and growth blueprint for 25. So I'll be going through some suggestions to consider. We'll be talking about obviously getting into the right types of positions for yield. We'll be discussing some alternative potentials as well. And at the end of the webinar, I'll also take you through a bit of a share screen session where I'll actually show a few of the stocks we'll be discussing, and we'll go through potentially what you'd want to look for and stay away from as it relates to dividend stocks as well. Okay, so first thing, obviously, just a bit of a disclaimer, we'll get that out of the way. The information provided by HNWIs is of a general nature only and does not take into account your personal financial situation, objectives, or needs. The information presented is for informational purposes only. Trading stocks and other securities carries risks, including the potential loss of your invested capital. Okay, so just be mindful of what you're doing and the risks you're willing to take. All right. So also, any questions, guys, you're more than welcome to pop in the questions section as well of the webinar. I did get a few questions from registrants already as well, which I've actually made some commentary for, and I'll go through them. And there's some very good questions there, actually. So thank you for those. And at the end of the webinar, if I haven't answered any of your questions, you're more than welcome to obviously reach out. I'd be happy to go through and discuss a strategy session with you as well. And also, you do have the option here, once I select the poll, which will be online for you guys to answer the question and ask me specific questions in that poll as well, or give me any sort of answer or statement to talk about. All right, so building a portfolio for sustainable wealth. Well, a few things we're going to talk about. The best ASX and global dividend stocks for 25. So not just focusing on domestic, we're also looking at international exposure here. Ladies and gentlemen, I think a lot of people seem to forget that we are in a vast economy with amazing opportunities globally, right? Now, meanwhile, obviously, yield and franking credits or dividends in Australia are favourable for imputation credits and franking credits. You just want to be mindful that there are higher income opportunities for higher yield internationally, and we're going to be looking at some of these options as well. Now, we're going to also discuss, obviously, what to stay away from. right? Balancing income and growth for optimal wealth preservation as well. We're going to be talking about too. Okay, so all right, the ultimate dividend blueprint. So why dividends matter? I mean, it's pretty obvious, right? Firstly, consistent cash flow, obviously acting as a hedge against market volatility, given that you're paid a quality of income. So dividend stocks obviously generate regular flow, cash flow, making them attractive for income-focused investors. Again, hedging against volatility, that's an obvious one. But companies that pay a consistent dividend, they do tend to have strong balance sheets as well. So this does help stabilize portfolios during market downturns, whilst looking for yield and growth in other areas of the market as well, right? So you do want a hybrid strategy, I call it, a hybrid strategy of yield, growth, sustainable growth, and maybe even some high beta plays as well. Okay. So historical outperformance, right? So historically, the S&P 500 Dividend Aristocrat Index, compared with 25 years of increase in dividends, has outperformed the S&P 500 over a long period as well. Okay, so it's obvious that an income stream is one thing, but the outperformance achieved through holding quality dividend pays is visible as well, right? Meanwhile, there are other strategies that on the short term can outperform. We do want a decent structure and hybrid strategy that involves quality income pays over the long term, right? So an example, obviously, over the last 30 years, there's been dividend paying stocks that have delivered 2 to 3% higher in annual rate returns on average than non-dividend stocks as well, right? So we're also going through here, the power of dividend reinvestment. So, reinvesting dividends, leads to compound growth over time, significantly boosting total returns. So a lot of these are supported by financial insights as well, like long-term returns. Again, dividend-paying stocks continue to contribute nearly 40% of total stock market returns historically, which is pretty impressive, right? Some examples we'll go through here for global investment examples are Coca-Cola, Procter & Gamble, Johnson & Johnson, but obviously much more. This is just a bit of an insight on some of the ones we'll be touching on. Some ASX listed examples are obviously Telstra, ANZ, Woolworths. But again, these are just more stable, slow-burning sort of yield plays, but we're going to talk about some others as well, right? So how to identify reliable dividend stocks? That's the key questions that, a key question that a lot of investors really do ask. Dividend yield versus dividend growth, right? So there is such thing that's sort of overlooked in the market from dividend hunters, and that is what we call a dividend trap. Sometimes investors opt in for that high dividend, but they get caught out on consistent downturns in share price and pullbacks in share price, and therefore get trapped in a stock that's been paying quality yield, and all of a sudden it's been downgraded in earnings and the yield payout has been reduced over the quarter or the year, right? So you want to be very mindful of that. So a high yield would be considered anything over 6%, I'd say. But you want to also be mindful that can be warning, a warning sign of an unsustainable payout as well in some cases. But it's also very achievable to get a quality yield higher than 6% and a sustainable one as well, right? Now I'm going to run you through some of the ways we're going to sort of filter that as well, right? But again, this is just a touch of the iceberg, guys. If you want more in-depth analysis and more quality dividend positions for 25, I'd be happy to run you through all that one-on-one after the webinar. Right. So obviously, key financial ratios to assess stability is what you're going to really want, right? So the payout ratio, right? So anything over 80% ensures the company is not, anything under, 80% ensures the company is not over distributing earnings, right? I'd go as far as saying maybe even anything under 75% as well, right? Dividend cover is the next one. So more than 2 times. So earnings should sufficiently cover dividends, right? So what you want is a dividend cover of greater than 2 in most cases, okay? Free cash flow being positive. Now, this is essential for long-term payout stability. This is one of the main metrics that you want to make sure is intact with the companies you're looking at, okay? And consistent dividend growth for more than 10 years. So a sign of high, strong financial moat is given when we know that there is a consistent dividend growth over a 10-year period. Obviously, 3 or 4 or 5 or more is still quite good, but to have that quality dividend payout, the historical performance over 10 years is really important. Okay. Obviously, outside of that, we're going to sort of look at the sectors that can benefit your portfolio for that play as well, and that would be financials, infrastructure and utilities, and resources. And some of the quality stocks on the ASX, BHP, APA, CBA. Now, look, CBA, I think, it's a little bit overrated sometimes. There are others that we can look at here at ShareWise, right? So I've got a lot under my arsenal that I'm going to be saving for clients that do want to work with me. But we will be touching base on some of the ones that don't look too bad here on the ASX. Right. Now, some other examples, obviously, Procter & Gamble here in the US. So, Procter & Gamble, I'm not sure if you guys are familiar with they do, but they offer a yield of about 3%. Payout ratio is about 6.3%, which is extremely sustainable. But the dividend growth rate year over year is about 7%, right? Now, this is a very, I would say, positive outlook for the long-term trajectory of their dividend payments. And we're going to go through the chart and have a look at that with a bit more detail as well. Okay. But I just thought I'd mention that on the side, just to sort of address an example of dividend growth, a payout ratio, and also, the forecasted cash flow, by the way, is positive. So that indicates strong cash reserves, ensuring future payments are intact as well. Okay. So we've also got, some key other takeaways for investing in the Australian positions as well for fully franked advantages. Obviously, you've got Telstra, roughly a 4% yield, stable in telco, right? You've also got, slide keeps doing that. You've also got ANZ, 5.5 roughly percentage yield, strong financial sector presence as well. And you've obviously got Woolworths, which is about 3% yield as well. Consumer defensive sector, that's one that could be looked at. But again, that global dividend positioning I would recommend considering is going to attract a lot more yield for clients at the moment, right, than just Australia. But obviously, imputation credits are important, and some of those names do offer that. Obviously, ANZ, Telstra, that's a no-brainer. So some of the ones we'll look at, again, Procter & Gamble, right? Coca-Cola, Johnson & Johnson as well. So Coca-Cola, about a 3.5% yield. So they've also got strong cash flow and brand recognition. So that's also another one to really consider as well from an international perspective. Then we've also got Johnson & Johnson, and you've also got some of the ones that are listed here as well. You can see on the screen, ExxonMobil, which we recommended about 2 weeks ago. The position is doing okay at the moment, not doing too bad at all. Realty income. Now, this is an example of one that has quite a high payout ratio. So there is a bit of risk there, but at the same time, you want to be mindful that the negativity could already be priced in, as we're also seeing a consolidation in share price. So this could be a good play for growth as well. And you've also got APLE REIT, Apple Hospitality. Again, a bit of a higher payout ratio, so it does offer a little bit of risk from that perspective. But even if they were to be bought here and they were reduced in yield, you're still looking at probably about a 5 or 6% yield between the two, right? So there are some opportunities outside of these, which we're going to talk about, but these are example of riskier ones that I just wanted to show clients as well to be careful on, and what to look out for as well. Not just the positives, but the ones to be mindful of, right? Okay, so if we go into the supporting sort of financial insights here, we've got, first of all, the defensive sectors like consumer staples and financials. They are more resilient in nature. Stocks with, again, positive forecasted cash flow can sustain payouts even during downturns, which I've already mentioned as well, right? Growth stocks that also pay dividends, which are really interesting for clients to consider looking at as well, is actually businesses like Visa and Mastercard, right? So these are companies that pay a quality dividend as well over time. And when I say quality dividend, their growth rate is fantastic, right? So these growth stocks with dividends provide compounding benefits, enhancing total return over time. Those companies also increase dividends from an outperformance of their earnings as well over time. So this is not only going to give you a benefit in growth, it will also sustain, obviously, a longer-term dividend play too, right? Based on that metric. So looking back into realty income, we're looking at a 5.7% yield paid monthly, okay? Exxon about 4.5%, strong balance sheet, and also Apple REIT 5.9%, I believe paid quarterly, but we'll go into that as well. I didn't mention that earlier, but I just quickly mentioned that before I move on. Okay. So, obviously franking credits make a considerable difference, clearly, for clients. So looking at high income opportunities on the Aussie market with franking credits is something that can sustain significant growth and yield for clients long term if you get the right business. So some examples are VHY, Vanguard, Australian Shares, High Yield ETF. Capital notes, an example of what there is ANZ as well, capital notes, and obviously Vanguard Dividend Appreciation ETF as well, which I'm going to look at with you guys on the share screen session shortly as well. Okay, so just going back through a couple of things as well in terms of growth stocks that pay a good dividend. Microsoft, if you look at this perspective, from a growth perspective, you get the best of both worlds, right? You've got growth stocks with dividends that offer capital appreciation and income, but you also get companies that increase those dividends through outperformance of their earnings, as I mentioned earlier. Now, again, the criteria for this is a return on equity of over 15%, earnings growth of more than 10% year over year for sustainable dividends, and then dividend CAGR 5 to 10%, which is strong capital allocation, right? So, from that perspective, if you look at Microsoft, that's almost a 1% yield, not much, but at 10% dividend growth. These are 1% yield, but a 16% dividend growth. So over time, this will compound, right? Now, obviously, I know they're not the highest of yield, but when you look at it from this perspective, we actually have monitors and blends to find higher growth opportunities and higher yield opportunities from the small and mid-cap range to improve the growth rates of client portfolios as well, right? Now, once you're a member with us, we go into those opportunities with a lot more detail. If you want to work with me, ladies and gentlemen, I can give you a lot more insights as well. However, at the end of this session, I'm going to take you through a couple that are paying some significant yield. I don't want to leave you with nothing, obviously these ones are minor yields, but I've got a couple that are paying more than 6%, quality dividends, fantastic metrics, but I've got so much more. So if you want higher quality yields internationally and domestically, we can go through all of that in a strategy session after today's webinar as well. Okay. So the importance of combining yield and growth, again, is to preserve your capital. As a high net wealth individual, you don't just want dividends and see your capital depreciate over time. You want capital preservation. You want growth over time, but you also want income. And the only way to do that is to invest adequately into quality performing businesses over time, right? And that does take a little bit of rebalancing sometimes, and it does take monitoring the market to find the stocks with the key screening criteria mentioned amongst a wide range of others as well. And again, we do all this for clients day in, day out. Okay. All right. So what I'm going to do now is I'm just going to share my screen, and I'm going to share a different screen actually, just to take you through a couple of positions that I've mentioned briefly, and we will be taking any questions towards the end of the webinar as well, right? So, okay. So guys, this is obviously APLE, Apple Hospitality REIT. Now, this is one that pays a quarterly dividend, right? Now, the yield on this is roughly 6.27%. So it's a little high, right? It's more on the higher spectrum. Sorry, I've seen a question come through here. Not to worry, Don. I'll answer that, mate, at the end. Thank you for that. And again, if you want a strategy session, mate, I'll be happy to take you through this with a bit more detail. Okay. So, all right. So APLE, we've got a 6.27% dividend yield, so a bit more on the higher spectrum. So what we want to do is we want to see whether the payout ratio is sustainable, right? Now, looking at this, it's about 112%. So be very mindful of this on buying. However, even if they were to reduce their dividends by, let's say, 20%, you're still looking at over 5%. And the consistency is brilliant, right? So you can see here in January 31st of 25, they paid a dividend again on the 13th. 31st of December. And then you've got the 29th of November. Sorry, this is actually monthly as well. My apology. So this is one of the ones that I mentioned were monthly, not quarterly. I've got so many that I look at. Sometimes I do forget. My apology, ladies and gentlemen. But this is again leading into what I'm saying when I say we've got significantly high quality dividend payers on a monthly perspective we can look at as well, not just quarterly, not just semi-annual, right? So we've got so many of them. So I would be very mindful of buying here, but the point is you just want to also consider the fact that it could be a higher risk dividend play, right? So just be mindful of that. Now, O, which was Realty Income Corporation, I actually really do like. Now, the only problem with this, if you look at the payout ratio, it is quite high. Okay, so at 200%. Okay, but again, this is a monthly dividend. Now, you would argue that some of the pullback in the share price might be worth considering an entry point here on the stock, but this is just an example of one you want to be careful on, right, before buying. Okay? I'm going to show you ones that are much greater in dividends that we've filtered through. It could be worth looking at for the longer term, but that do carry risk. And if you do want to maintain looking at these businesses, we can do that slowly over time together on the investment side here with HNWIs. Okay, so if we look at this, obviously over time, it's one that's been trending around this range for quite a while. We've got a target of about 12% from here. They are a real estate investment company, so they generate monthly dividends from their REITs across the US and globally, and they're headquartered out of San Diego as well. Okay, so Procter & Gamble was another one that I wanted to look at. Now you can see consistent growth over time in the share price. So if you adjust it for yield, it's fantastic over time. Obviously, the dividend is only about 2.4%, roughly 3% in total, but the ratio is only, payout ratio is about 63%. So over time, this is a quality long-term buy for clients, right? Okay, so they engage in consumer packaged goods, Procter & Gamble. So this is one to really consider. We would be considering looking at this for clients as well. They recently reported an earnings beat as well. So they've been earning by over 1% on the recent earnings report back in the 22nd of January, right? Now, one that I really wanted to share with clients today is a bit of freebie, right? Good quality company, growth is fantastic. They have just ran significantly and they're consolidating a little bit. Now, this is a bank, right? This is a finance institution out in the US on the New York Stock Exchange listed. They've been consolidating for a little while now. I wouldn't recommend buying it right away. However, they are reporting earnings on the 19th of February. Okay, so this is not advice to go and buy it today. What we're saying here is this could be a fantastic dividend play. And again, we would consider looking at this for 25. But if you want a quality entry point, contact me. We can get into this at the right time, right? Now, the dividend here is impressive. If you look at the yield, we're looking at only a 40% payout ratio and an estimated yield of 8.5%. Now, that's brilliant. If they were to increase their dividend payouts by double, they're still going to be underneath the recommended payout ratio to be looking for as a dividend payer, right? Now, I would suggest that this may consolidate closer towards $80 a share, but that 8.5% dividend is just impressive, isn't it? But we've got a forecasted price target from the consensus of brokers at about $150 a share, which is impressive, right? Now, again, they're in financials, so they serve as a high and mid-income. They serve the low and mid-income individuals and small and mid-sized companies as well, from savings accounts, checking accounts, term deposits, funds management, and lending as well, right? So they are a banking institution, and we do think this is one that could do extremely well. Now, what's really interesting is the volume has been rising over time, and the price has been coming off. So we would be considering looking at this as a buy at some point here, right? So this is showing us a golden opportunity at the moment. From a Fibonacci retracement perspective, anywhere around this level would be an excellent potential opportunity, right? But again, carries a lot of risk, and they're reporting earnings on the 19th of February, 2025. Okay, ladies and gentlemen, so this is one that could be a fantastic opportunity. Now, Coca-Cola, one that we were looking at for clients before, reported earnings, 6% beat the other day, 6% beat in revenue, and you can see here the stock's popped. So this has done fantastic. We've also got a target price from consensus of about 10% higher at about $72 a share. So we're already doing well for clients here as well. All right. Again, earnings growth, fantastic. Regular dividends as well. Again, obviously, this is a lower yield, but the payout ratio is pretty sustainable, right? 79%, not bad. Okay, so over time, this is one that we would consider to look at, maybe wait for an optimal entry point here as well. But again, this is one that you just want to make sure that you're getting it at the right time, right? So it's already popped a little bit here in share price. We would recommend waiting on an entry, okay? A good example of the stock that's just been downtrending over time is APA, right? I mean, if you look at this, I mean, it's a great yield, but I mean, in the last 2 years, it's dropped 40%, you know, since January 23. I mean, it's just, yeah, I mean, I would argue this is an opportunity to be looking at as a buy, but this is one example that if you've been holding it over the last 2 years, I'm sure your performance is probably, you know, underrated, right? As opposed to looking at something like, look at that. That's just fantastic. Okay, it's uncomparable, right? So if you want to make more money, you got to just talk to us. We've got so many options, we've got so many opportunities, and this is just a touch of the iceberg. Another one is ASC. So this is one that's rising. They're a shipping corporation, okay? So they are reporting in 2 days. So again, we'd be very mindful of that. But if you look at the recent consolidated movement we're seeing here, could be one to do really well. 30% is their payout ratio, 9% estimated yield. Impressive, right? Now, their income statement hasn't been too bad. Again, they're reporting earnings soon, so you want to be mindful of that. Target prices are 41% higher from the current level. That's pretty impressive. Okay, so they provide seaborne transportation of petroleum products and chemicals, right? So again, be very mindful of an entry point. You want a good entry point, talk to us here at HNWIs. be happy to help you get a better result here as well, okay, for an entry point. So, ladies and gentlemen, I think I'll leave the share stream there for now. But we've done very well for clients recently. If you watched the webinar over the last few days, we've also discussed some opportunities for growth that have done really well. I'll just briefly touch on those as well. So TEM, right? That's been doing really well. So if you guys bought into TEM in the other webinar, well done. I'm sure you'd be up a little bit there on that as well. But again, briefly, just going over this, we were buying this for clients well before the webinar as well, right? So we've done really well on that. Last night, Palantir saw some consolidation. Look, it's likely to potentially consolidate a little bit given the volatility we saw in the market. So Palantir, we might see a bit more of a pullback. And just be mindful that stocks do like to fill gaps, right? So if you do look at this, we've got quite a bit of a run here. We might fill this gap. We might consolidate in and around this level. So we may consider taking a little bit of profit off the top, but it has been upgraded considerably from a wide range of brokers, and it has outperformed as well already, right? So, you know, we might consider taking a bit of profit here at the moment. All right. It's PLTR. A couple of others that I'm looking at going back into at the moment for growth, just FYI, are companies like Tesla. Okay, so PSLA, we just pull that up. Oops. That's been coming off quite a bit, right? So we were taking a lot of profit in and around this range. It's been coming off quite a bit. We're waiting for a good entry point. You know, I'd argue that we want to see it retest the 200-day moving average at the moment. Okay, so just be mindful of that if anybody's buying Tesla, but it could be worth looking at a re-entry soon. So again, if you want to work with me on the advisory side, I'd be happy to go through this with you as well. All right. Now, what I'm going to do, ladies and gentlemen, while I answer a couple of these questions, is I'm going to pop a poll here, right, for those questions that you might want to answer and ask. So that's launched now. Whilst we do that, I'll also answer a couple of questions from some clients that have asked questions before the webinar has started. Okay. Just pull those questions up. Okay. So one of the questions from an attendee and registrant earlier, which is a really good question, by the way, was how will interest rates impact dividend stocks in 2025? Really good question there. So first of all, high interest rates, they typically hurt high yield dividend stocks because bonds and fixed income alternatives become more attractive compared to dividend stocks, right? So, you know, some investors then opt in for bonds as opposed to stocks, right? So what that means is you get a lot of pullback in positions on the stock market, even if they are high quality dividend payers. And this is what I mean by you want to be careful, and we can also consider looking at alternative investments. So one that I mentioned in the webinar earlier that we could quickly look at right now is an ETF that the Vanguard ETF. Right, so VHY, sorry. Look at this. Absolutely incredible performance, right? Now, if you look at that, that's a 6.9% yield as well. Okay, ladies and gentlemen. So that's also one that you just want to be mindful of to consider as well. And I did say I'll take you through this. So that's one that, thought would be relevant to this. And some of the other points I wanted to make with this is companies with higher debt burdens like utilities, REITs, they do face higher borrowing costs, potentially impacting dividend payments as well. Now, I just illustrated APA Group. I know a lot of Aussie investors have probably been invested in APA for a little while, but this is an example of a business that's depreciated in share price over the last 2 years as interest rates have remained higher, right? So we can still get you good yield. Please don't be stubborn. Look at other areas of the market, and this is what we can do, right? There are so many options out there. So the reality is, if you want that quality return, you need to look for quality opportunities. And the way to do it is the way we are doing it. It's a hybrid style, and you want to be open-minded to other areas, okay? So also key points with that question as well, John, is companies with low debt and strong earnings growth can sustain and even increase their dividends despite higher rates as well, okay? So, sectors like technology, consumer staples and financials tend to be a little bit more resilient sometimes, okay? But look, for 2025, the outlook, if central banks, sort of continue to cut rates in the US, and in Australia, start cutting rates, you could see dividend stocks, especially high yield stocks, also significantly recover and do quite well. But if rates stay high for longer here in the Aussie market, you can expect increased pressure on leverage sectors like utilities, REITs as well. Okay, just something to keep in mind. Another question was, should investors prefer high yield or high dividend growth stocks? That was an excellent question, and as a matter of fact, I think I've already answered that question in the webinar, right? You don't just want to fall into a trap of buying a high yield stock if they don't meet the metrics of the payout ratios and other metrics that we do cover, because it can become a dividend trap. But if you buy a stock with a good dividend growth rate, with a historical increasing growth rate in dividends, this is something that I would opt in for as a little bit more safer for clients, for growth and for long-term capital preservation as well, okay? You don't want your capital to drop 20% over the next 2 years and then get paid out 5% per annum. I mean, what's the point of that? We can do the best of both, and the way to do it is as I've mentioned, okay? So good question. There was another question which was asked. What sectors offer the best dividend stability during recessions? Well, Procter & Gamble, some examples are defensive, sort of, and resilient consumer staple businesses can be quite attractive. Some utilities and infrastructure can be quite defensive, but also healthcare as well, like Pfizer, Johnson & Johnson. The yields aren't that high, but they're quite defensive as well. Hope that answers that question. And in that sort of environment, you want to avoid cyclical sectors like energy, discretionary goods, and for example, that they may cut their dividends during downturns because of the economy, obviously being in a recession. So you just want to be mindful of that as well. But I don't think we're quite there right now anyway, so it's not something I'd be too concerned about. I'd be more focused on getting growth and focusing on the best performing businesses to attract a better growth rate in yield. Okay, and we can look at that as well, as I mentioned. So guys, I'm going to finish that poll here. But if you've got any questions, again, you're more than welcome to pop them through. I did get asked a question from an attendee live. There were a couple of questions here live as well. So Jeff asked, explain dividend payout ratio, please. I think I've really answered that, Jeff, again, I think, mate. So obviously the payout ratio is the ratio of which a company has distributed its earnings to clients. Yeah, so US stocks are subject to withholding tax. As an SMSF intention, this amount is lost. Does your yield account for this? Meanwhile, we don't provide personal advice. We do understand that, but again, just keep in mind that obviously the yield, if you're receiving a 15% yield or a 14 or a 12% yield, and you lose 20% in withholding tax or 10%. I would rather buy a company like that that's performing well, preserving my capital, yet still paying me a quality long-term dividend and pay the tax, personally. Okay. But look, very good question. Guys, I think I'll leave it there. I do have a lot of follow-up calls to do today. I've got a lot of clients that are coming on board. Thank you so much for attending. If you've got any other questions, if you're looking to work with us, if you want better opportunities for yield than what you've got, you want a portfolio review, come on board, let me know, leave your details. I'd be happy to work with you and we can start the process from there. Thank you so much for attending. Justin here at HNWIs. Looking forward to hopefully speaking to you all. Take care.